Hello, everyone. This is JT Mullen, Chief Investment Strategist at Fairport Asset Management. Once again, I'm here with John Silvis and Rick D'Amico. As most of you know, John, our Chief Investment Officer, manages the research of the investment team and oversees the overall investment process here at Fairport. Rick, Manager of Investments, oversees the implementation of the firm's fixed income models and is responsible for the review and oversight of Fairport's alternative investments. Well, we're finally getting close to the end of this election season, so why don't we start off there? Do you think the results of the election will impact 2016 returns, John?
Well, I think we're in a heightened period of volatility over the last few months, and I think a lot of people connect that with the elections, which is probably partially true, but in the bigger picture, August through October tends to be the worst 3-month period within the markets anyway. So I think that regardless of the election, we would be seeing that volatility now. But I brought out a chart that we've used in the past, but I wanted to kind of address it again. So we look at things in a 4-year presidential cycle, and the election year, which is the one we're obviously in now, is the 4th year of the cycle, and it tends to be positive. In fact, regardless of Republicans or Democrats in the White House, it tends to be positive about 6%. So I don't think in the big picture it matters who's in the White House. I think people will say this is not a typical election, and that's probably true. So maybe we might see somewhat different outcomes. But in the big picture, geopolitical events don't really have long-term effects, I don't think, on the direction of markets. They do have effect on the short-term volatility of things, which I think we are seeing. But we tend to look at things over the next 3 years, not the next 3 weeks. And I think after the next 3 weeks, we'll get much more clarity, and the markets will adjust to those things, and we'll move on to something else, which would be the next geopolitical event, which we don't know. In the bigger scheme of things, as we look at the election, regardless of who wins, Cornerstone Macro, which is a group that we get research from and has done a lot on the policy side, thinks the Republicans hold the House. They have about 70% chance of them holding the House. So we're probably going to see divided government either way, much like we see today. So it's probably more of the status quo than people think going forward.
During the third quarter, we saw equity indices hit historic highs, and they've come back down a little bit since then. Do you believe the economy is positioned to enable equities to perform well into the end of the year?
Yeah, so we saw the domestic equities, as you mentioned, hit an all-time high in August 15 to be exact, as you using the S&P 500. Outside the U.S., it hasn't seen highs, but we definitely have seen rallies. In fact, the best performing asset class so far this year has been the emerging markets. They're up about 16% so far, well, at least through the end of September, bouncing back from last year, having a negative return. In the bigger scheme of things, volatility is prevalent this time of year, and people tend to get a little squeamish about the election and the overhang there. But in the big scheme of things, we're going to see corrections in the markets, and corrections of 5 to 10% are not really uncommon, even in a bull market, which we're in today. So, as far as the economy goes, I think it's kind of the same message we've been giving for a while. I think the long-term growth of the economy is doing okay. As you can see on this this chart right now, we're seeing about a 2% GDP growth over the last since the expansion started, and since the second quarter, which is kind of behind us at this point, but it was about 1.4% going forward, in which the third quarter, and we'll get to a better number next week. Unfortunately, we don't have it right now, but the Atlanta Fed does the GDP Now survey, and we've talked about that in the past, has an expected return about 1.9% GDP growth in the third quarter. So, we're kind of just grinding forward as we have in the past, and I don't think that's really going to change. I think the bigger thing is the probability of a recession or the concern of a recession is probably still pretty low, given the current data. And a couple of things I would point out. So as you see on the next slide, unemployment, the job market, I think in general, and the job picture is still pretty positive. Unemployment claims, as you can see in the current chart there, have actually hit a 43-year low. It says 42, but the most recent number actually pushed it down to a 43-year low, going back to 1973, if I'm not mistaken. And if you really wanted to take a better look at it, back in 73, only about half the working population we did today. So really, we're at pretty extreme lows as far as unemployment claims, which I think tends to be a pretty good real-time indicator. Unemployment rate still is at 5%, so it's been at 5% or below for the last 12 months. So I think the job market, the job picture is looking pretty good. The other part of that would be wages, and as you can see on the current slide, household incomes rose about 5.2% in 2015. So I think coupled with the job market, coupled with better wages and wages picking up going forward, I think puts us on pretty firm ground. The other thing I think is also a positive is the housing market. And we've talked about housing in the past, but I think it's important to point out because it is a big driver of the economy. And the housing market has, I think, been a bright spot really since the last few years. As you can see in this slide, the value of new home sales was up 14% in the month, year over year in the month of August. It's down a little bit from the previous month. In July, it was actually up 31% year over year. So I think we're pretty firm ground in the job market. I think the housing market looks pretty firm. And I think if you look at the housing starts over an annualized period, we're building about 1 million houses annualized through September. If there's any area of concern or a thing we're looking at, I think maybe the downside so far has been just on the manufacturing side of things. A couple of different things to point out, as you can see in the slide in front of you, light vehicle sales have been kind of flat for the last few months. I don't know if that's the peak or we're just a consolidation, but that's I wouldn't say it's a concern yet, but it's something to keep a close eye on. Capital goods, which is the one below that, which is everything outside of aircraft orders and non-defense orders, has been stuck somewhat in a slightly downtrend there and hasn't really seen a pickup yet so far. Still hopeful that we'll see that going forward, but so far we haven't really seen any pickup there. If there's any positive come out of the election, I think both candidates are talking about more infrastructure spending, which should be a positive for capital expenditures. So maybe that's a silver lining coming out of all this.
Right, but this is something that, this has been the pattern since 2008.
Yeah, no, that's correct.
John, are you concerned that PEs are getting higher?
No, we still think that we're well within what is an acceptable range on the price to earning multiples. If we use this chart quite a bit. If you look at the 25-year average, it's about 16 times earnings. Since we've actually ran this chart, we're closer to about 16 and a half times. So we're not really that far off the long-term average. If you look at the box up there in the upper right corner, it talks about where you are within standard deviations, which either means one standard deviation above it or below it, and we're well within those ranges. So I don't think it's a big concern.
And the components of that are interesting also in terms of the average PE.
Right. So if you look at the slide, the current slide, there's really two areas within the market, and I'll show you a couple of slides on this, that are kind of driving the price to, I wouldn't even say driving the price to earnings ratio higher, but having it a little bit above average. And it really boils down to the energy sector. As you can see I put a red box around it. It's trading at 55 times forward earnings, which is well above the 20-year average of 17. And that's driven by the decline in oil prices more than anything else, really decline in energy earnings more than anything else, and I'll show you that in a second. And the other one would be the utilities, which is trading about 17 times forward earnings relative to the long-term average about 14 and a half. Again, that one's driven more by low rates. People are looking for better yields, so they're going into the higher yielding securities like utilities. So I think, and I don't like to parcel this too much, but if you look at it, I think those are the two things driving that, and I think you can see both those come down going forward. The second chart gets a little bit more into what I was talking about as far as energy. It's the one on the bottom. So energy earnings have been going down, and you can see that. But as you look to the right of that chart, they're going to start to improve here going into the second and then into the third quarter. So I think as we see the year-over-year comparisons start to pick up, because oil's been above $50 for a while here, I think that's going to be a positive for earnings, energy earnings going forward. The top chart talks about the dollar. So if there's two things we're concerned about, I guess, is the direction of oil and maintaining that $40 to $50 range, and then also the direction of the dollar. And had you asked me, 3 months ago or 4 months ago when we were right around the Brexit, I would have thought the dollar would continue to go down. With the passing of the Brexit vote and both the pound in the UK and then the euro in Europe, both declining pretty quickly against the dollar, that's kind of has put a bottom in so far. Going forward, we'll see. But as you can see, a year ago, on that top chart, the dollar was up 19% year over year. Currently, we're down about 1.7% year over year. And if the dollar holds where it is today, you'll see that continue to be have a negative year over year percentage-wise, which will actually be positive for earnings going forward. So those are probably the two things we're watching closely.
So things look pretty good on the domestic side. We really haven't seen an economic impact from Brexit yet. Do you think it's coming?
Well, so far we're on solid ground. Haven't really seen too much fallout from Brexit. And it's only been a few months, and some of these things take a while to filter through the economy, so I wouldn't declare victory at this point. But I think in the bigger scheme of things, global growth still looks pretty good. If you look to the upper right of this chart, or this table, it shows you all the what we call the PMI numbers, which is the Purchasing Manufacturing Index numbers, which is a pretty good indicator of future growth. Anything above 50 would be considered positive. And if you look at the UK, it actually went up over the last 3 months. It went down in July, most likely from the concern about Brexit, but it has bounced back. So in the short term, hasn't really seen anything negative out of Brexit. I think it's a little too early to take the victory lap and say it's not going to have a longer term view. They're still just even talking about the mechanics of how that will go. So we'll see. But even if you look at the global PMI in general, it's at the highest it's been since last October. And if you strip out the United States, the global PMI numbers minus the United States is actually the highest it's been since October. So I think things are actually heading in the right direction.
Do you feel positive in regard to emerging markets?
Yeah, I think, we've seen positive growth in the emerging markets. Their equity markets are up, as we mentioned earlier. If you look at the slide to the left there, purplish line is expected GDP growth in 12 months, and it's actually starting to move up in emerging markets, which I think is a positive, and I think we'll continue to see that. If you look on the right there, it just shows emerging markets earnings by different regions. And I wouldn't read too much into region by region, but I think if you look at the returns since the beginning of 2016, they've all kind of turned back up. So I think you're seeing better economic growth there. You're going to see better, hopefully that would translate into better earnings going forward as we see on the chart there. So I think things look much better than they did a year ago at this time.
Thank you, John. So we're hearing good news on the equity side. Fixed income has performed well through September, with the Barclays aggregate generating a return of 5.8%. Would you share with us the factors behind this performance and your outlook for the remainder of the year, Rick?
Sure, JT. The two primary factors responsible for the strong performance mostly through the first half of this year have been spread compression through a number of different credit sectors, as well as a decline in yields from where we began the year. A good example of this is on the chart that you see in front of you, which basically speaks to spreads within the high yield market. That top line is basically the spread for the energy sector within the high yield universe. And as you can see, we've had a lot of spread compression within that sector. John mentioned the recovery in energy and oil being above $50. That helps a lot of the high yield issuers as well. So spreads within the high yield sector have narrowed over 1,000 basis points. And then spreads within high yield in general have come in about 300 basis points, leading to the strong performance of the index, which is up about a little over 16% for the year. So that's one factor. Another factor, as I mentioned earlier, has been the decline in interest rates that we've seen, not only here in the United States, but across the globe. If you look at the chart on the right of the page, as you can see, there's still 33% of government bonds that are offering negative yields. And, in our view, central bank policy will remain accommodative. As you can see on the left side of the page, the target policy in Japan and Europe is at this time forecasted to be negative out through December of 2018. The only target policy rate that the market views as increasing is here in the United States with the Fed. And that's one of the factors that's helped keep a lid on interest rates here in the U.S., just the difference in yield between U.S. Treasury securities and German bonds, and also, Japanese debt, along with a lot of the other issuers in Europe. As you can see on this next page, private foreign investor net flows to U.S. fixed income has increased significantly since 2015 as a result, of this opportunity for investors to pick up yield here in the United States. As you can see, the flows into treasuries as well as corporate bonds. Now going forward, I will say this: over the last couple of months or so, rates have started to increase somewhat, and they're near some pretty important support levels. What you see in front of you are yields on key Treasury securities, and I'll just focus on the 10-year constant maturity bond. It's trading at 1.75%, and that's right at a critical support area that Ned Davis views as being important. So, it's one of the things we'll look towards, and if, rates were to decisively move above that, we may be able to use that as an opportunity to possibly reduce duration somewhat.
Finally, will the Fed implement another increase before the end of the year, Rick?
In our view, our base case scenario is for one interest rate increase in December. The Fed seems pretty adamant about increasing rates this year. If you look at the chart in front of you, these are Fed funds futures probabilities for interest rate increases. Pretty slim chance that it'll happen in November, but there's over a 67% chance that they will increase interest rates in December. I think a number of the things they look at are heading in the right direction. If you look at the chart in front of you, the unemployment rate is down to 5%. And as you can see, that bottom blue line, you're starting to see an increase in wage growth, which was at 2.7% as of September 2016. So, historically what we've had is when you've had the unemployment rate converging, with the wage growth, you tend to see some possible inflation pressures building. And, like I've said before, inflation is a lagging indicator, and Fed policy works with a lag. So one of the things they would like to do is sort of get out ahead of, any sort of inflation pressures, as opposed to playing catch up and, raising rates at a faster pace down the road. One other slide I thought was interesting, just given the current political environment, some folks have, stated that the Fed is politically driven. I thought this was an interesting chart. It's put together by Roberto Perli from Cornerstone Macro, and it shows each election year, and it shows that the Fed has either tightened or eased in some form or fashion every election year dating back to 1972. That wouldn't lend a whole lot of credence to the fact that the Fed is very politically driven, and they're just going to kind of sit back and let things be. Also, which was interesting, is he notes that the number of times the word election appeared in the FOMC minutes in recent years has been 0. So just something, that I thought was important to note.
Thank you, Rick. Clients and friends, thank you for your time and interest. We appreciate being your partner who can give objective and unbiased financial advice. We enjoy sharing our thoughts with you, so please let us know if you have any questions that we did not address today. If you have a friend or family member who needs a trusted financial advisor, please call a member of the Fairport team. And go Tribe!